Welcome to this Sifted Talks on life after unicorns. How are VCs measuring success in a downturn? Well, so we're here obviously to talk about, what this means for VCs, but because 2023 is shaping up to be a year like never before, and how are top VC firms navigating this unfavorable economic climate? And is unicorn chasing still the only rule that matters? So that is the kind of topic we're here to explore today. And my name is Mimi Willing, and I'm a senior reporter at Sifted, and I'm moderating this session. So we're also doing this session on VCs measuring success in a downturn in partnership with Affinity. And we'd love to hear your thoughts, so please submit your questions throughout using the Q&A function. We will try to answer them throughout. So let me introduce you to our panel. So we have Dinika Mahtani. She's principal here at Cherry Ventures based in London. Welcome, Dinika. We have Namratha Kothapalli, principal at Speedinvest, focused on climate tech. And Shikha Ahluwalia, principal at Balderton, based in Berlin. And we have the three VCs, and then we also have Dan Polonka, senior product marketing manager at the analysis company Affinity, that can be described as a CRM for deal makers. And Dan, you have lots of interesting findings from your most recent reports that we are looking forward to hearing more about during this session. And great to have you all on this Sifted talk. Well, if we hit off with our questions then, I think. First of all, we have all talked about unicorns for quite some time. And well, is this still the measure of startup success, or are we looking for something else? If I start with you, Dinika, what do you think?
I think the measure of the number of unicorns in every venture capital's portfolio became a very outward measure over the last 2 years. It's something that people marketed. It's something that obviously journalists talked about a lot. But I think internally as VCs, the goal is to build great companies, and the goal is to build great companies over a long period of time. So our fund cycles are 10-year fund cycles, and whether a company is a unicorn today or is a large impactful company that is a great business in 10 years, internally as the way we measure ourselves is and will always be the way. So I think the short answer is, the formation of unicorns is a paper metric. And ultimately, the way we measure ourselves as VCs technically is DPI, the amount of capital that we return to our LPs, which can only happen if great companies are built over time. Whether they're called unicorns or not, it doesn't really matter.
Yeah, I do remember when Volt was acquired by DoorDash, and I think it was Sifted Ventures that said that they had done 200 times their investments. Later on, that might not have been true, since the economic crisis actually ditched all the tech shares. But that means something, right? So even if you want to grow big companies, the LPs want to see a return. What do you think? Shikha, you're Balderton. You're also one of those who actually invest throughout from early stage to later stage. How has that been for you, and how do you see it?
So I'd agree actually to a lot of what Dinika has mentioned, and ultimately the focus will remain on chasing great teams and chasing the world's largest problems and trying to solve them. Versus trying to chase valuations. And so we believe that ultimately outsized outcomes are a byproduct of chasing what I just mentioned, including great teams and trying to solve big problems of the world.
So has there been a shift to big problems then in comparison? I'm not saying that the fintech apps of our world isn't a big problem as well. I'm saying, are we moving towards other segments that are more long-term, have bigger impact on in other ways? I suppose, or?
Yes, so one way to put it, of course, is sort of the big problems of the world, and the other way to put it are frontier technologies. And every kind of frontier technology has, I believe, a cycle or a hype cycle attached to it, or basically like we see in AI right now, with a strong shift in large language models, GPT-4 now reaching up to GPT-5, that things are possible now that weren't before. And so this has definitely, I would say, started an AI frenzy, justified or not, to try and capture value in that space more strongly than I would say in others right now. In general, as a VC, we are generalist in nature here at Balderton, and so there are a couple of areas that we remain incredibly excited by. AI is definitely one of them, and others also include, for example, healthcare or even climate tech that I believe Namratha is also especially covering.
Yeah, so Namratha, climate tech, obviously it's been one of those areas which been obviously, we can't really call it a hype, we can call it a hype, but it's also because of our climate crisis, right? So is that, would you say that that's different to invest in that in comparison to other technologies?
I exclusively focus on climate, so I cannot comment on the others. But with the war in Ukraine, energy crisis across Europe, supply chain issues across the board, I think there is a lot of interest, and I think both Dinika and Shikha mentioned that we're here to invest in really large markets that have a strong critical need, and climate really checks the box. It's not just investing in something that's good for the planet, but something that's absolutely necessary, and helping large companies, but also people to reduce emissions, lower bills, but on the other hand, also, I guess, adapt or cope with the consequences of climate change that's already here. And I guess all of us do feel that in some way, shape, or form. And especially, I think, like right now in the US and Canada, there's like wildfire. So people are actually feeling it, and it reflects in the work they do, the businesses they're building, and so on and so forth.
Have you had the same focus on unicorns before kind of 2022, 2023, or have you had a different kind of viewpoint looking at climate?
I guess at the end of the day, we're all kind of chasing large exit valuations, right? They remain absolutely key for funds. It's just that in the last few months, maybe like a year or so, the ideal financial profile of a large outcome has changed. And, thanks to interest rates, inflation, so on and so forth. And what this has translated to is the markets rewarding companies that are emphasizing profitability as opposed to growth at all cost sort of mindset. And the companies that are focusing on climate sustainability topics are also rewarded in that sense. So the greener the company, the higher the valuation. I guess the polluting the company, not as much, and it's reflective of consumer interest, but regulation across Europe too. There's like a whole alphabet soup of regulation that's already in place and also coming in the future, kind of forcing like large corporations to adapt more sort of sustainable measures and metrics reflected in public market companies, but also pre-IPO and all the way down to early stage startups.
And Dan, what do you see in your reports? I mean, do you have anything on this?
Yeah, absolutely. So we have our 2023 investment benchmark report coming out for Europe in a couple of weeks, and some of the findings that we've had from an industry perspective. There's a lot of sentiment that agrees with both you, Namratha, and Dinika, where we're looking and seeing that the energy industry has sort of been the standout segment in Europe over the past year, with around $34.6 billion raised across around 1,400 deals in 2022, and a large segment of that has obviously been climate tech. As you mentioned, this was sort of spurred by the Russia-Ukraine conflict, driving a need for renewable energy and also the European Green Deal. We are also seeing right now that Europe is actually growing faster than the US in climate tech. It's growing about 26% faster, having raised 42% of all climate tech dollars in 2022.
That's interesting. Yeah. So, I mean, if we then go back into a little bit like how it is to actually for you guys to find your deals nowadays, how has the deal flow changed since, a year ago? Dinika, if I start with you.
Yeah, transparently, not at all. Not at all in the early stages, because there are many, many amazing entrepreneurs still looking to build companies. There are many amazing entrepreneurs still looking to build companies in areas that we're excited about. And they're, extremely interesting companies looking to build in spaces that we know deeply. Now, what has changed is that if I look at sort of deal flow in the past year, or really past GPT-4's launch, I would say 1 in maybe 3 of my pitch decks have been AI companies or companies leveraging the power of large language models. And the truth is, I don't blame founders for wanting to leverage what is game-changing technology and building things faster and better. So I think that's the biggest change I've seen in sort of the sourcing journey is, sourcing has very much, even though you're looking for something in, say, marketplace businesses or in food tech, where I spend a lot of my time, there are a lot of applications of AI in businesses these days.
Yeah.
And perhaps adding to that, one way to look at it, rather than sort of AI being really a separate vertical, what is likely going to happen, or we already see happening, is that AI is just going to be part of core business models over time across verticals, really. And so this is sort of, a different way of sort of how to build a company and a tech stack in general, 23 onwards, versus really saying and going out there and building an AI company. What does that really mean? Because we believe that ultimately every company will touch upon AI one way or the other to make business processes more efficient.
So AI is the new tech company?
I guess it's just part of the stack.
Yeah. Akin to when AWS changed the game totally as well. And everything sort of migrated into the cloud. Like no one builds a cloud company these days. It's just part of the way they operate.
It's a great analogy.
So, so what then? I mean, if you have the same deal flow coming from, early stage companies, has anything else changed in? I mean, we have had an economic downturn. Many companies, I would think, would feel like, well, it's actually quite hard to raise now. People are talking about dry powder, but I mean, are you actually sitting on that dry powder so you can actually invest in all these companies, or are you still trying to find the right team to do it? I mean, and compete with each other on that. I mean, Shikha, what do you say?
Yeah, I think maybe quickly coming back on your question with regards to how deal flow has really changed at several stages. While I do agree that early stage, particularly seed, has not changed very much over the last, I'd say, 18 to 24 months. Certainly what we do see industry-wide is that the growth stages is definitely an area where it's just taking more time for high quality deal flow to come through. And that could be simply, one of the reasons could be simply that there are companies out there that have raised a ton at handsome valuations in the past, which also means that there is an element of growing into the valuations and being ready in terms of top line and traction to go out and raising the next round. And so this is a phenomenon that I guess globally, but particularly also in Europe, we see trickle down. And ultimately that is going to mean that teams and companies perhaps are taking more time to grow from a handsome A or B valuation and really get growth and Series C ready.
And how does
if I can, sorry, if I can quickly add to that, that's something we're finding across the board too, is that deals are simply taking longer, and that time frame or duration is stretching out the further you go down the lane. So earlier stage deals are not being as impacted as much, and then those later stage deals are being impacted heavily. As was mentioned, a lot of firms right now are just not sure where the economy is going. A lot of LPs right now are not sure where the economy is going, and it's much harder to raise a round right now. So firms are just, holding on to their capital and being much more diligent when it comes to the types of companies they invest in. One thing that we did find in our analysis is that right now, deal makers sort of predicted that for 2023, about 45% of their new deals would come from their existing network. So that is a sort of huge factor in what companies people are investing in, the relationships that they have and who they can trust to provide them the proper insight and steer them in the right path.
So has that changed in that later stage startups no longer reach out to 40, 50 VCs to get the right money? Are they doing it differently? I think we spoke about the Shikha, maybe.
Yeah, I think in general, what a great approach is there, and I think Christopher Jans from Point9 was someone who sort of blogged about this very early on. Perhaps this may have been even 10 years ago. So this original idea is not coming from me, but ultimately smart investors certainly invest in lines and not in dots. And what I mean with this is that ultimately as you get to know founders, you get to know founders over a period of time. And so every encounter with the founder is sort of a dot, and then you have sort of a cloud of dots, and you can essentially draw a trend line through it and try and understand where that, where that aligns, the strong alliance with the founder would ultimately lead to. You can sort of start and draw trend lines. And ultimately, this is sort of a mode that a lot of investors are in or have been in. But similarly, smart founders should also meet their investors in lines and take checks from investors in lines and not in dots. And so, in line with this analogy, what we do recommend to other founders in general, and something we also see in the industry, and would be great to hear your thoughts as well, Dinika and Namratha, is ultimately reaching out to investors at growth stage for founders is usually a set of known investors that they have been in touch with for the past rounds. Or have had many catch-ups in the past. So you don't really run a cold process, but a familiar timed process with people who are truly interested and have formed conviction over a period of time versus just got to know you 2 weeks ago.
Yeah, I could not agree more. And, I think at Cherry, the way things have changed for us, while I mentioned that, not much has changed in sort of top of funnel deal flow, is the way we're supporting our companies moving on to Series A and B, right? And I think if I talk about sort of the way we spend our time, we're spending a lot more time doing pre-screening calls with VCs that we know, who may be keen on the space, may not be keen on the space, maybe sentiment has changed over time. And so, we're doing a bit more of the brokering and sort of the relationship building on behalf of our founders, at like our early stage founders, which I think is really important because particularly in this market environment, you want your founders to be focused on building companies and spending time with investors who may not be interested in the space or may have changed their views over the last 18 months is super important. So what has changed is the amount of time we've been spending with sort of later stage investors just to get a fresh view of what's interesting for them. Are they still investing? What are they looking for? And funneling back that information to our founders.
Because I know that Cherry Ventures usually say as well that you are very good at finding, a Series A investor to your startup, so you can actually see that the early stage startups actually go on to get more money invested in them at the later stages. So I suppose as a VC as well, it's really important for you to get those early stage startups to also find new investors, because you can't do so many follow-ons that will actually keep the company alive, right?
Exactly.
Yeah. So how is it with you, Namratha, for Speedinvest? I mean, do you have the same kind of focus on finding new?
100%. I also get the sense that at a slightly later stage, the VC networks, people are a lot more collaborative, and the idea is to enable sort of long-term financial and strategic support for companies, and that's sort of left, right, and center in terms of like what kind of company do you want to invest in, and what sort of syndicate do you want to organize for companies, things of that nature. Maybe slightly different on the earlier stage side of investments. I think as huge outcomes seem a little less likely, VCs are also looking to buy at a cheaper valuation, which kind of comes at a cost of owning a larger share of the company than previously. So in that sense, maybe at a slightly earlier stage, there is a little bit more competition, if you will, to invest in the best founders in the best market, so to speak.
Yeah, sure. And how do you do that? I mean, do you have to have, because many of the founders, obviously serial founders, and they start a new company, and those people are obviously on your radar. But for early stage founders that haven't actually started a company before, it's obviously more of a risk maybe, but you still want to, if it's a great idea, a great team, you probably want to be in there anyway. I mean, how do you, is it too risky now? Is it?
We are, as a result, going earlier. So we are doing more pre-seed than seed, and I'm sure it's the same for others as well. And the rationale is twofold. A lot of multi-stage investors are slowing down at the later stage side of things, but keeping the sort of pre-seed and seed practice open, kind of informed by the previous crises as well, when phenomenal companies were being born, and now there is sort of promise of AI, energy security, and things of that nature. So, and also, I guess, intention to buy companies at a cheaper valuation. So there is a lot of competition at pre-seed and seed. As a result, we're also going kind of earlier. I think to Shikha's point, I think sometimes we don't really have the privilege of investing in lines because we are investing in really early companies where it's like pre-product, perhaps pre-revenue. I think sometimes the website is not there, or the website just incorporated a couple of weeks before we invest, things of that nature. But it's an opportunity for us to come with sort of a prepared mind or have an understanding of the market, which also is sort of the Speedinvest pieces with like multiple teams that kind of have a view on the market and have the corresponding networks to support and make a relatively quick decision in terms of DD.
And I mean, because of you having quite a lot of, I mean, I don't know about you, because obviously harder also to raise new funds, but if you have dry powder, as we used to speak, like money to spend, and the Series A and Series B companies are not really coming through at the same speed. I mean, do you feel like you want to invest more early stage then, just to make up for that, to be able to, or do you just keep the money and wait until you find that perfect opportunity in a later stage startup like a Series A?
I guess I can start with that one, if that's all right. And I agree with a lot of what you said, Namratha, and Mimi, coming to your question. I think ultimately great founders and great companies are going to find capital no matter what, and those deals will continue to be incredibly competitive. And whether that's seed, it's definitely Series A, Series B, Series C, perhaps less, but you do see very competitive early stage and sort of earlier growth stage deals. So that does happen, and founders ultimately who are out there with a strong proposition, interesting, compelling figures are going to raise, and those deals will be very, very competitive. So I think it would be difficult to sort of say, simply because it's a question of what is the supply in the market, that that we certainly we're not sort of per se shifting our focus of investment, nor have we in the past. To be fair, we've very transparently been investing from seed to IPO. So we come in very early with 1 million check sizes, but we also go up to 60 million and check sizes and become more flexible as you progress in rounds. And so there's certainly the notion of sort of shifting our focus towards something separate is not what we have done in the past and not what we do right now. But there's definitely a case of being fewer high quality deals in certain stages, but that doesn't mean that we aren't looking very, very hard and close at them.
So if it is is it more competitive now than for 2 years ago, you would say?
Well, I think you have a stronger riff than perhaps 2 years ago, and perhaps this is something that Dan can comment on, because he's actually the guy with the data. But ultimately, I see you have maybe like a top slice of really high quality deals, even in Series A, that get done fast with a lot of attention. And then sort of there is a large riff in between, because there are many companies that have raised seed in the past but aren't quite there yet for Series A. So I would actually say, in a weird way, it has gotten more competitive, at least for the top end of the companies that are raising, because there are fewer great companies in the market right now out to raise. And it's a bit of it's a bit complex, because you would expect that it's less competitive, whereas some end of the market has actually got more competitive in our view.
Good for those companies. But Dan, please.
I'd be happy to add to that. So anecdotally, we've definitely heard from our customers that there's a lot more competition for quality deals right now. And then we did do a predictions report at the beginning of the year, as I mentioned, where we asked VCs what they plan to spend the most time each week on this year. 39% said that they were going to be looking at prospecting as sort of their top priority. And then 23% indicated that portfolio support would be a top priority. So that sort of follows the theme that we've been talking about, where we need to be going out there, we need to be finding deals, and we need to be spending a lot of time on that. And then once we do have those deals, sort of in our portfolio, we need to be doing everything we can to help those companies grow and remain healthy. Right now with exits just not necessarily being the next step that we're going to see right now. The other thing that we're finding in terms of being more competitive is that companies are looking to invest internally in things like data and machine learning and AI, as we spoke about earlier. So right now, firms have, referenced that they spend about 34 hours of research per deal, and that they require at least 4 data sources to properly evaluate a deal. And that number seems to be growing the more we talk to companies. We actually partnered with Andre Redrath of Data Driven VC recently on his landscape report, where he mentioned that 84% of VCs right now want to increase efforts to become sort of a data-driven VC firm, which he referred to as having at least 1 engineer on staff and having developed sort of internal tooling. So 84% say they want to do that, but that only is occurring in 1% of firms today. So there is what we're going to see a huge rush towards using a lot more technology in finding those deals, because there is a huge competition. The person that has the most data, the person that has the most intelligence is going to be ahead of the game, is what we're expecting.
Yeah, this is something that I remember when EQT Ventures came out with the Mother Brain for many years ago now. And then since then, we've seen lots of different, well, not the brains, but lots of AI products out there to find the right deal and so on. But I suppose that it's a lot about contacts as well, and that you guys are working a lot to have this kind of both getting leads, but also having this relationship building. I mean, would you say that you as investors are spending much more time now and actually working on those relationships? Dinika?
Yeah, definitely. I think it ties into what I mentioned before about why we're investing in those relationships. And really that ties for us into how we can support our founders. I mean, the goal is for us to, ensure that our founders can raise money when they need to, and they raise money from the best and most relevant investors. And so that's a lot of the legwork that we're doing on the later stage side of things. And then on the earlier stage, yeah, I think while Namratha is right in that a lot of funds have moved earlier, I think for us, we've stuck to sort of our core, which is, seed. And seed being, we have to work with both angels, angel investors, earlier stage funds, for example, like Speedinvest, creating our own pipeline. So, convincing founders that we know and love to build their own thing. When you're creating your own funnel, sometimes that's not necessarily shown in the data, to Dan's point. But I think all of the combination of those things means that from a networking standpoint, that's for us more important now than ever.
Yeah. And to offer someone a term sheet, I mean, how much data do you actually look at now? I mean, how do you, because now in comparison for 2 years ago, now it's profitability and being able to show that you have enough customers, paying customers, or at least interest for your product, I suppose, right? Yeah. So, I mean, that has changed, I suppose.
Yes. So yes and no. I think, if you look at sort of a few of the US investors, right? So, Benchmark investing in LangChain, 10 million seed round. My understanding is that was done with 2 amazing founders and not much. So deals are still getting done by the best venture funds into the best founders with very limited information, and in sort of topics that we think will sort of change the way the world works. Obviously for us at Seed, which is our core, yes, definitely, product demos, customer calls, the full spiel of diligence is what we have always done, what we'll continue to do. And I think the current market in some ways favors VCs because, we don't need to turn around decisions in a day, which means that, 18 months ago, we would sometimes do a bit less work. We have a bit more time to sort of really evaluate a company. And maybe one thing that hasn't been talked about that I want to mention is for great companies that we're on the board of, and maybe I'll give you an example of, a company in the Cherry portfolio where it's a Series A company going on to Series B. Sometimes I think what's interesting about this market is that investors, so internal investors, have the ability to preempt rounds because companies know that it's a very challenging market out there, and don't want to go out and raise externally. So if investors have the ability to have sort of the seat at the table for companies in sectors that aren't sexy sectors, you know, this is something that we've definitely seen where we're like, hey, we're excited, we love the progress. Just take more money from us. It'll save you a lot of time and a lot of hassle and sort of going out to the market.
Is that something you see as well, Shikha and Namratha?
100%. I think it doesn't get talked enough. You know, there's a lot of value and time saving in going to your existing investors and trying to work out a fundraising plan B, so to speak, or fundraising pivot, if you will, and not be stuck in like 2021 and 2022 when it was like a slightly different period where it was easier to raise. Like absolutely, it's something that we see and are having active conversations with our portfolio as well.
So is it more about, I mean, do you prefer an extension to the round before, or do you want to see a whole new round? I mean, the Series A, for example, instead of a extension to your, I don't know, your seed stage. I mean, see what I mean?
Yeah, I think in general, sort of this is a tricky topic. We have so far seen that you know, typical seed plus rounds, in the sense that, you know, founders perhaps going out 8 months after they have raised their past seed and sort of trying to top that up in a case where perhaps the business is not significantly de-risked, but the valuation has probably increased, then that is, you know, particularly from the risk and return profile, something that is not very straightforward for us. And so we would rather say that, you know, perhaps we wait another 8 to 12 months and give the business time to grow out and to get to a point in terms of traction and also in terms of business metrics that is more compelling overall. But then we also very clearly say we're actually happy to hang on and pay up and pay and pay a larger price for a later round and then come in with conviction, rather than investing in the business that isn't significantly de-risked. And so I think what we've all seen over the last perhaps 8 months are tons of those rounds, which is a seed extension or an extension to the last round, which perhaps has not been sort of the right fit for us in the past. We prefer priced rounds with significant progress. And that's always easier said than done in the current environment for reasons we've enlisted before. So yeah.
And sure, it's always hard to grow at the same time as cutting costs, I suppose, for companies.
A couple of points I'd like to add to Shikha's. I think there is also value to prove to future investors that there is, I guess, the founding team can manage the runway well enough to ride out the downturn without relying on a lot of external funding. B, also, I guess, proving that the company could grow into a really healthy business with attractive economics and cost structures built for efficient growth. I think that's what the market's rewarding now. And if the company can move in that direction and show to future investors, I think the valuations or the upticks, etc., they kind of tend to like adjust themselves in a way.
So how much have you had to become more like business development experts and helping your portfolio companies cut costs and deal with the things that are necessary instead of actually burning through that money? I mean, how much do you have to get involved now?
I can go. I guess it's a work in progress, right? We have a team internally that supports with some of these aspects. So a sort of a CFO team that can work with our companies towards that. And I think to Dinika and like Shikha's point earlier, we're building networks across the board. And a part of that network is also around how do we support our portfolio companies in terms of growth and progress and things of that nature. I don't necessarily think that has changed that drastically, but there is a renewed emphasis on can we provide warm introductions when it makes sense? So yeah, continue to do that absolutely.
Great. Dan, do you have any great numbers to share with us. You can think, do you want to think about that one for a second? We'll take some questions, and we will bring the next topic with you. So we have one here from Sasha Rai, and thank you for your time. How do you see investing in startups across different countries in Europe? There are different standards in different countries, and perception of VCs is different in different countries. Is there a way to bring in homogeneity? What do you think?
I can go. I mean, I think at Cherry we invest pan-European, we're a pan-European fund, and I think that, you know, for us, we value a founder in a market like Romania as much as we do a market like Ireland. It all depends on how amazing this team is to execute against the idea that they have, right? So for me, I understand that different countries and different markets have their own nuances, which is why sort of we have a team that tries to straddle different cultures that can hopefully fit with all the different cultures in Europe. We have a team in the Nordics that does this. We have a team obviously covering DACH. We have a team in the UK. And so, I mean, all to say is that the simple answer to that question is, while I think most of funding activities in Europe tend to happen in 3 key hubs, and you can't avoid that because of the historical nature of how our financial systems in Europe have been set up, the best founders across all of the different countries in Europe remain well-funded, right? Whether you're from Croatia or Budapest.
That's a great answer. I have another one here, and it's from Tobba, Torbjörg Helga, and it's a question about the financial situation, and if your question to founders have changed, and then how. So when you ask founders questions, I mean, have they changed them, Shikha? Do you ask them the same thing as you did for 2 years ago?
I think it's a super interesting point, and sort of I personally come from a founding background myself. So before I became an investor, I was a founder for 5 years, and so with that hat on and looking back now at the last 18 months, I think definitely what we're keen to understand is like I mentioned before, how the business has potentially grown, and sort of how the growth profile would look in the current times, and then ultimately growing well is also a reflection of how you're navigating the current business environment and to what extent you're able to do so. And ultimately that is entrepreneurship. And perhaps not huge marketing builds and using that to fuel growth. And so I think it's much more about finding out what the founders are capable to do with rather fewer resources, and then what they can bring to the table then. So questions have definitely changed, and being more excited to hear the answers to how the business has done over the past couple of quarters.
Sure. I have one, we're going to do one more question here now, and please keep on sending in your questions. I will get to them later on as well. But we have one from Svetlana Novikova, who is actually talking about the VC ecosystem. And do you think there will be an impact of the current downturn on how much talent the VC ecosystem attracts in midterm? Any danger of a career in VC space being less attractive to the younger generation of entrepreneurs?
That's a great question. I have a pretty strong view here. So the VC ecosystem in general is a very small one, if you think about financial services as a whole. So, early stage VC, a segment of its own, sort of later stage VC, and then, growth investing, and then private equity, all sort of different parts of private market investing. I think the size of VC funds indeed grew over the past couple of years. And as long as VC funds have funds to deploy, I think the size of teams will stay sort of as they are, right? You need to source deals, you need to support your founders, you need to, support your founders through exit. I think what's really interesting, though, is this question of desirability. And my view here is that so long as you think that there are, tectonic shifts that will continue to happen in technology, there's no better industry to have a front seat at the show. And as long as that continues to be desirable for people, which I strongly believe it will be, then I don't think VC will ever lose its charm of being appealing as a place to work.
Yeah. And Dan, let's move over to some numbers. What do you have in your report? I love those numbers. I love those reports. They're great.
Yeah, absolutely. So first, I want to highlight that Dinika mentioned Croatia. We did see that they actually grew 400% year over year in terms of actual investment dollars. So they're a great market to be looking at right now if you're interested in that space. But I will say that a lot of our conversation today has essentially boiled down to how much you're talking to people, what type of outreach you're doing, whether it be some of those business development tasks we talked about, whether it be working with those early stage companies where you don't have a lot of information and you need to be having those conversations, all the way down to supporting your portfolio companies and allowing them to leverage your network or finding out who they want to be connected to move on to that next round or find customers, whatever it may be. So we, for our upcoming report, did an analysis of what we refer to as top VCs versus the average VC. And when we speak about top VCs, we use the metrics of those VCs who invested in at least one company that became a unicorn in 2022. So looking at that, we found that in terms of outreach, top VCs sent more emails consistently for every quarter over the past 2 years. And we also saw that while outreach numbers trended downwards for the average VC, they sent about 18% less emails at the end of 2022 than they did at the beginning of 2021. Top VCs trended upwards, so they saw a 14% increase. And some of the things that we found, we recently hosted a webinar with Lucille Boom of Briga. And through that and some of the research we did for that, where we were looking at just generally some strategies for how you can be automating outreach, we found that right now associates are spending up to 60% of their time right now on tasks surrounding email outreach. And then looking regionally, we found that while all regions experienced a drop in the number of emails sent in H2 of 2022 over H1 for both top VCs and average VCs. So that sort of indicated to us that there was a pullback towards the end of the year, as maybe people were looking to not, what's the best way of putting it? So some deals may have stalled, or they were raising rounds and they didn't want to burn bridges by being too annoying, essentially. So they might have pulled back on some of their outreach at that point in time. We do still see that as outreach is sort of the clear starting point of success, as it leads to more network growth, and that moves on to improved deal flow. And again, it can, definitely you want to be making sure that you're having those conversations to source new LPs. And if you're having conversations with LPs, you're going to be more able to accurately track and forecast on fundraising. And then anything you can be doing to drive stronger support and valuable connections for your portfolio companies, as I mentioned, to talent, customers, and investors, is really key right now in terms of maintaining a healthy portfolio.
That's great. I was just thinking about all the different events that all the VCs had here, even in Stockholm, the last couple of weeks, and I'm amazed on the outreach part. But I mean, you mentioned also the LPs there, Dan, and it's quite interesting to see, obviously the LPs are of huge importance. You, both Dinika and Shikha and Namratha, you are principals at your different VCs. I mean, how much do you actually interact with LPs, and can you say something about how that kind of relationship is moving on now when it's an economic downturn?
Yeah, I do. I do have sort of interactions with our LPs in sort of various capacities. At Cherry, some of our LPs are exited founders, some family offices. And so, our interactions with LPs tend to be in and around co-investment opportunities, being excited about sort of reporting to them all the things that we're doing, deals we're excited about. And so I think, given the economic downturn, where if you think about capital allocation, it totally makes sense for LPs to diversify away, right, from just private assets into, public equities, public debt, and higher yielding assets that, in a zero interest rate environment, made sense for them to pile more into the private markets. Again, back to sort of network building and communication, our job is to ensure that we're keeping these relationships as close and as tight as possible. So yeah, that's.
What about you, Namratha?
I guess I can go along the same lines. Like, I think a lot of the LPs that I am in touch with are curious about, I guess, more R&D and innovation. They're more on the corporate side as well. They want to, I guess, reduce the emissions of their supply chain in a sense. So they're super curious about what sort of like the decarbonization topics we're looking at across supply chain, energy, things of that nature. So business development opportunities. At the same time, also opportunities to sort of invest alongside us going forward.
Of course, because they needed the kind of innovation as well, right? To to bring to the big companies to actually survive and to thrive. And Shikha, what about you? What about Balderton?
Yes, and for us, why I would say that the global world is our backyard. Europe is very much our home, and our LPs, of course, do take interest in our activities across Europe, having been in the region for over 23 years as one of the oldest funds or firms here. And so we're happy to take meetings across Europe, including in other office spaces in Berlin as well, as LPs do take interest, not just in sort of the sectors and the areas we're looking at, but also sort of a geographical coverage and what are sort of the specialties and the nuances that we understand in the DACH region that they also take increasing interest in. Okay, so you haven't had any kind of problems with LPs in this kind of economic downturn? Everything is like glorious times. And... Well, I think it really depends, and I think when you look across the pond towards the US side of things, well, I do believe that things are a bit more tricky across the pond than in general they are over here in Europe, and perhaps that's a function of Europe maybe not drinking as much and therefore not having as dire of a hangover. Potentially that's a way to put it, but ultimately that means similar to I think great founders finding capital, great funds with great teams will continue to find capital and draw capital from LPs as well.
I think Mimi, your point is that ultimately it's true that LPs are going to be diversifying away from venture as an asset class. And I think, we're all aligned to that point. And so definitely sort of fighting for allocation from LPs is going to be more important than ever in the future because, interest rates will continue to not be at 0%. And so then it's a question of sort of how you keep those relationships and how you build them. And I think that's what we're saying. So I don't think we've come to the point yet where it's going to be super tricky to raise money from LPs, particularly because our three organizations have also been around for quite a long time and have built sort of these relationships over, 10 years. That's quite critical. Now, I think the story is a bit different if you're an emerging GP in this market. And that can be sort of a topic for another Sifted Talks.
Sure. But what would you say has been then the key difference for you in your work in the last 2 years? How has it changed the most, would you say?
For me, it's the board conversations always start with how much runway do you have left? And sort of just brutal sort of focus on, as a business, how are you doing? And I think that's really important because, say, a year ago, the focus might have been on growth at all costs. And that has really fundamentally changed for us.
Yeah. Shikha and Namratha, do you have different answers?
Actually, so on our end, I think what has drastically changed over the last 12 to 16 months or 12 to 18 months is also for us internally that the notion that founder well-being and being a top performing founder is not about, especially now, not about working 18 hours a day or 20 hours a day and putting the responsibility of the entire world off your shoulders. But we actually believe that a high-performing founder is ultimately like a high-performing athlete, in that he has a host of advisors around him. And that includes board members and mentors, but that also includes a balance of physical activities, mental well-being, and being great at your job. And so actually, this is something that we are trying to focus on, or that we are focusing on here at Balderton, even more so now than before, trying to provide the right kind of ecosystem and the right kind of support to our founders, because frankly, the reality is that navigating any kind of environment that is changing fast is very, very tough and troublesome. And sort of I've been in a position where I've had to let go of 150 people in my team within 10 days. That was years ago in a different setup, in a different environment. And the truth is that it stays with you, and it's very, very tough.
Imagine.
To Shikha's point, I think it's very top of mind for us that it's easy to be there with somebody, even founder, when things are going really well, but to be there when things are going not so well, and being able to provide that sort of support. So we're trying to, I guess, have more touch points with founders, meet them more often, and also I think like advisors and mentors who could support them, not just on a business front, but people that have kind of done it and gone through similar journeys. So founders don't have to learn these lessons by themselves, but take advantage of others' experience to get there rather quickly, sort of thing. That's something that we're emphasizing on doubly more so now than before.
It's just so true. So I'm going to bring in a last question here as well, and it's from Aaron, and he says that, well, we have come across a couple of news mentioning where unicorn companies across the region have slashed their valuation internally over the past 12 months. We know about those ones, right? Do you think the similar trend will persist, or are we expecting a valuation shift in the next 12 months? Difficult one. So, Namratha, you look like you're...
I can go. I cannot predict the future, right? I think a lot of like really awesome companies, especially at a later stage, are adjusting the way they grow to emphasize or focus more on unit economics, path to profitability, quality of revenues, with a renewed emphasis on payback, focusing or doubling down on core markets. And I guess US expansion is slightly less critical. And these are the things that, you know, like as companies prove that they're resilient and go out to fundraise, let's say, 6, 8, 12 months from now, these are the things that they will be evaluated on. So maybe, the valuations will shift, or maybe companies prove all of these sort of extra proof points and keep the valuation because they're doing phenomenally well when different things are expected of them. Yeah. So kind of yes and no, and no one size fits all again.
No. Dan, what does your number say? Will we see a shift?
Yeah, I was going to say, I thinking to Namratha's point about not being able to predict the future, and going back to something Dinika said earlier about how when you asked her how her sort of behaviors have changed, how the Cherry's processes really haven't changed that much. It makes me think about we do expect valuations to slowly rise, but we're probably not going to see that high speed environment that we saw 2 years ago, right? So I think it's not so much about like predicting when we're going to get back to that time, but thinking more in the long term and thinking about from a firm perspective, do we have scalable processes in place? Have we built a strong network, and do we have tools that allow us to leverage that? And do we have the data in place that's going to help us discover those deals before our competitors? So if you do develop a consistent process and you are sticking to that and not really worrying about the day-to-day of the market, I think to Dinika's point, you're going to be in a much better place time over time as opposed to being purely reactionary. So that's sort of a non-answer. But again, I think the main point is that, yeah, the we're hopeful not to see sort of the hangovers that we saw from the 2021 market, if that makes sense.
Okay, well, at least we can look forward a little bit to 2024 and hope that things will be better than a little bit
Absolutely.
better. Well, we are about to run out of time, so we will thank for the questions that we have received throughout this session, and I'm sorry for some of those that haven't been answered. And I would, we had, I mean, I can't even summarize the theme here, but we obviously been looking at the VC world and how you have changed and not changed in the last 18 months or so, and you really come with great knowledge, and thank you, Dan, for all those numbers and insights.
Thank you
Thank you very much for that.